Cheshire. Welcome, everybody. For those of you just heard J.Thelander, I'm here with Al Chesser from GetDynasty. This is our second, actually, QSBS and sort of compensation event for the last one we did was private company for those that you joined us. And now we are on with the investment firms. And I know from all of you with us that we have a full range of people from finance to investment and to HR. So we're looking to cover all of your questions. We'd like this to be interactive. Morgan on my team is monitoring the chat. So please feel free to send your questions in. And I'm going to go ahead and get started. Al, you want to give a little background for a second about what you all do at GetDynasty?
Yeah. So we are a fully licensed Nevada trust company, and we focus specifically on QSBS, Qualified Small Business Stock, Section 1202. And what we do is we help startup founders and startup investors get more QSBS using trust. So you create trust for your family members, and each trust gets a separate QSBS exemption.
Great. And J.Thelander, founder and CEO of J.Thelander Consulting. I'll give you a little bit of background here. We are a namesake firm. Name on the door is, you're looking at her, and we are a private company and private capital market compensation data and consulting firm. And so we have both breadth and depth of data, and we also use our own data to consult. We have a great podcast, J.Thelander, that I do with Morgan, who's also my daughter. I hope you listen in. We did a pod with Al, so that's available to watch on all your usual places, Spotify, or you can see us on YouTube so that you can watch it. Let's get into the investment firm compensation data a little bit, and then Al, you'll plug in about sort of, I think what this shows that having the data is great, but in terms of the cash and the carry, but then planning for the wealth creation and to maximize that wealth and minimize the taxes is really the priority here. So this just gives you a little bit of background on the types of firms that participate in our investment firm compensation survey. We're co-branded with PitchBook on that, and the survey is open all year round. And the data is real-time updated on our platform. And so we run a survey, I think, is the interesting part about it, because you can't plug into payroll and get any of this information. The biggest way to look at a firm's compensation and understand the carry structure is by the assets under management. And now we have firms that are well over 20 billion of AUM. We were just looking actually at a project for a client in that 1 to 3 billion. And you can see that the compensation is a little different in the larger fund sizes. The comp gets more robust. We also look at how many funds are currently being managed, and this is by total AUM. You can see that obviously, as you would expect, the more funds being managed, typically the larger AUM. And the location of our firms are global. About 85% domestically in the United States, and also within the United States, we're covering the country. Maybe, Al, you want to talk for a second. I mean, where your firm is, the primary location of your firm and where you live really does matter for QSBS.
That's right. It's very important because QSBS is only applicable to U.S. C Corps. So, and also U.S. residents, you have to be a U.S. taxpayer. So it's not applicable if you live overseas or if you're investing in overseas companies.
Yeah, we do cover now Europe as well pretty extensively, and then within the global footprint, other places as well, but Europe has become a significant sample size. In terms of the data that we cover, we're going to go through it. We tried to, looking at the titles of everyone who was on the call, we tried to match the titles of information that we're giving comp for, but all of these titles are included in what we surveyed. We're down up to, 6 levels of investment professionals from associate all the way up to the top managing GP. And now there are a lot of positions that are in operations and portfolio services and investor relations, all the way down to receptionist. The only plug I'll put in here is on the Thelander platform. When you participate in the survey, Morgan's going to put the link up. You unlock 12 months of real-time access to the data that you get back for no charge. So it's really an easy ask because there's no downside to it. Okay, let's get into Al, your part as well. So breaking this down, the compensation for an investment firm is cash and then the carry. And we look at the cash compensation as a base salary and the actual bonus, and we do track the target bonus as well. And then the carried interest is the percentage of a fund's profits. It's usually an 80-20 split. And we also track carry dollars at work or an equity distribution. So Al, maybe you want to take over here about how does QSBS fit into this? Like here, if you're looking at a managing general partner, this data we pulled yesterday for a VC firm that has less than $1 billion of AUM, to really figure out how QSBS factors in here. So you're looking at the total cash, but when you're looking at these carried interest percentages, how does QSBS, what is it, and how do you structure it?
Yeah, so here's what it comes down to. Just like when an individual invests in or is employed by a QSBS eligible company, and so like I can show one of my slides here to show what is a QSBS eligible company. And so I think that's probably the first thing to go into. QSBS eligible companies have to be a U.S. C Corp, as I mentioned, and then there's different exclusion amounts, but it really depends on the companies. The investment that's made into the company has to be made before the company exceeds a certain asset limit. So this is divided into two rules: old rules and new rules. Old rules are for any companies that were invested in before July 4th of 2025. That's the big, beautiful bill date. And so that's the old rules. The new rules after July 4th, 2025. So you can see here the difference is a $10 million exclusion. What that means is if you invest in a company before it has $50 million on the balance sheet before July 4th, you would get up to $10 million in tax-free capital gains. And that's per individual. So it passes through from the investment into the company directly into the GPs and LPs that have a percentage carry in that.
Right. So when we look at the
investment.
carried interest of, let's say, the percentage for managing general partner we saw in our slide, let's call it 29%. And that's of the 80-20 split, meaning 80% is the LPs and 20% is the GPs. And then this is of that 20% that gets invested in a portfolio company. This is the $15 million in the new rules today that this relates to.
That's right. And so the best way to think about it is the first 10, if you're investing in QSBS eligible companies, the first 10 or $15 million, depending on when the investment was made, can be 100% tax-free federally. And then state, it depends on what state you're in. If you're in 42 out of 50 states, it's also tax-free at the state level.
Yeah, that's where the geography really matters. I'm going to show a little bit more data because it's important to understand what you own, because that's where the numbers for QSBS get in. So this is a managing general partner at the 75th percentile. And this comes from the comp planning tool on the Thelander platform, which we've built because we used to only do this for client projects and consulting, but it's a great tool to be able to look and see as your assets under management are growing, what happens. This is the bottom line is AUM, and then this is the percentage of carried interest. So it helps firms plan in the same way private companies need to plan when they're looking at dilution of their total amount of financing raised. When there's more assets under management, you can see that the total cash goes up. And that's often in part as well because you've got to make a capital contribution for your carried interest. But nonetheless, you can see that the piece of your pie gets smaller. So if you're talking to a managing GP, Al, what would you guide them here?
I would say the most important thing, it depends on the stage of your fund. And later stage investments don't have the ability to multiply as much, obviously. And so when you're thinking about QSBS specifically, the question you need to ask yourself is, can I make more than $10 million on a single can I personally make more than $10 million on a single investment? If you don't think that's likely to happen, then you just, there's no more optimizing you can do. You live in your state, you're going to get the federal QSBS benefit up to $10 billion. But if you think you could potentially make more than 10 on a single investment, then you can look into creating trusts, because you get your $10 million exemption. But if you create trusts for your children, your spouse, each one of those can also get additional $10 million. You can stack them and you can get $40, $50 million worth of QSBS
So what do you
exemptions.
mean by stack them? Explain that.
Yeah, so let me show that slide. Okay, so you can create trusts for your spouse, your kids, your sister, your mom, different family members,
Right.
and you're putting part of your carried interest, you're gifting it to these trusts.
That's
So
like
you
a
don't,
vertical slice of your carry.
that's
It's funny.
right.
We asked this in our survey. Actually, do you allow vertical slices to gifting? And so when they say yes, those are the people that we should be sending to you, because they should be planning for this, because it does. Each trust can get that 10 to 15 million in tax-free gains.
That's right. If you have 3 children, you can get an additional $30 to $45 million worth of QSBS just by creating trusts for them and putting some of your carried interest in those trusts. Now, when
Right.
we do a vertical slice, a very important thing is you can't just put your carried interest. If you also have committed capital in the fund, you have to put a proportional interest from that into the trust as well. So if you do 10% of your carry, you have to also put 10% of your capital interest into the trust also.
Yeah. And let's take a look more at the carry breakdown, because I think it's important, because this really is the crux of it. And then I'll go back to show a little more comp data, because I know everyone's interested in it. But here is the total amount of carried interest for the firm. And it's typically, for most firms and funds, the 80-20 split. It can vary depending on, we work with family offices, and depending on whether there's one LP or multiple LPs, it can go down to even that 10%. And then here is family offices, exactly what we were saying, versus VC for less than 500 million AUM. So it's just really important to understand what the full carry picture is. And when you're more junior, it's even more important to understand this, because we're going to save the carry dollars at work for another webinar, because it's too much to get into. We'll just stick with carried interest. And then the vesting time for carried interest is another piece of this. And you can see that overall vesting times are on the uptick over the 10 years. How does that factor in, Al?
With QSBS, you can gift before the carry actually vests. In fact, that's the best time to do it, because when it comes to putting your carried interest in a trust, the best time to do it is when that carried interest is worth nothing, because you're gifting to a trust.
So
And so
earlier on,
the earlier
especially
the
with an
better.
emerging fund, right?
That's right. I actually have a slide on this as well. So there's a lifetime gift limit of $15 million. The best time that's the only amount you can gift your entire life, $15 million. Even if you create multiple trusts, multiple family members, 15 is your cap. Every dollar over that $15 million limit will get taxed at 40%. That's the gift tax, the federal gift tax, which is almost half your money. And so when you have a new fund and it's worth nothing, the carry's worth nothing, that's the best time to gift some of that carry to a trust for your family members, because then it takes up very little of your $15 million lifetime gift exemption. And so that's where it comes into play with vesting. You can do it before it vests, and the best time to do it is early.
Yeah, well, now that the vesting times are taking longer, that you have plenty of time. But obviously, especially if you're an early stage investor, like you're saying, as opposed to a later stage investor, you would assume that there's more runway, because where
Yeah.
you're starting and where hopefully there's a liquidity event will be at a different, there's greater gain to have. So this is the vesting time equal each year, or does it change over time? Just, good information to know. And then here's the other part of this. So, and Al, you can let us know how this factors in. So this is what the percentage of the committed capital do the GPs have to contribute. And we typically see that at the 1 to 3%. And then you can see this has been really stayed the same. This is our year over year data, 23, 24, 25. And then this is the median percent of capital that the investment professionals contribute to the most recent fund. And obviously, it's very top heavy on the managing GP versus a senior managing director or senior partner, and it gets smaller as you go down. How does that factor into the QSBS or your gifting? Is it after you've already, you put your committed capital in?
You can do it after or before. If you haven't done it yet, then what you do is you put the committed capital that would be required from those trusts. You have to gift that money into the trust, and the trust will actually make the capital commitment. So either way works. But most customers that we see, it's after they've actually committed the capital. And so they can just vertical slice the carry and the capital interest.
And how does that work with other capital calls throughout the lifetime of the fund? Because it isn't just at one moment. Is it going to be the total amount, or let's say they have capital calls along the way?
So it's going to be the prorated amount depending on the amount of carry that goes into the trust. So if you're only putting 10% of your carried interest into the trust, 10% of that capital commitment will be required by the trust as well.
Got it.
Because
That
you're
makes
really looking at it as like you don't own the carry anymore. This trust for your child owns the carry. And so they're going to be responsible for that capital
What if you
commitment.
decide that kid is awful or something's happening with them? I know all of you are who have children are thinking, yeah, I have felt that way. Can you take this back or what happens? Are you locked in it, locked and loaded? There's no way out?
So irrevocable trusts are irrevocable. You cannot take them back. There is some flexibility. You can add other beneficiaries to the trust. In some instances, you can reassign a beneficiary. But most importantly, what you can do is you can put in control so they can't use the money. They can only use the money in these purposes. So like that's the whole purpose of having a trust is you put guardrails on how the money can actually be used.
Yeah. Okay, great. I'm going to show a little bit more data on some of the other positions that we know folks who are on the call. So this is for a director principal. So this is obviously you see that a big drop in terms of the percentages of carried interest, right? Here's the managing GP at the 75th percentile. And we had showed the first one, the managing GP for the median. And now this is at the 75th percentile. And this is across all firms. Really the biggest important inflection is to look by the assets under management. So as you get into the higher AUM, you can see the slice of the carry is getting bigger, and so are the total comp numbers, likely because there's also a capital contribution. And now you're at a director principal, which is really a nice mid-level. And you can see that things have leveled off and still going up for cash and the carry really just staying. Any comments in terms of what you've seen, Al, in the market today with the carried interest moving around and the amounts with the clients that you're working with?
I mean, it's exactly what you're seeing here. You know, the managing directors get the most, the later stage firms have to make larger capital commitments, and then, the more junior investors, they have less percentage of carry, but at the larger funds, they make more salary. It's exactly what you showed there.
Yeah, here's a couple other data points. And then we'll get into this is the 75th percentile. Look how stable this is. This is what I love
Wow.
is that you can decide what you want to do with this. What firms, I mean, we work with on the consulting side all the time, and we know that this is where the leveling of our data is really important because we can tell when a director principal at a bigger firm is different than a director principal at a smaller firm like title inflation. And you can really see how consistent the data is from 2022 all the way to 2026. Almost crazy, right? I mean, we know there's been swings in the market, but it really shows you with the vesting times getting longer that there is a lot of stability in these firms because there sort of has to be because it's a long game. I mean, the IPO market right now in liquidity has been extremely tapped down. So here's a CFO position for a venture capital firm that's got $1 billion to just under $5 billion of AUM. So you can see the total cash and really 25, 26 been very stable as well as with the carried interest. And then here's the 75th percentile, right? 2.5, but even at the 75th percentile, not wild swings. So you want to walk us through a little bit more of your data, Al, and show us what's going on in the different states. Actually, I'll show you the one part here that will dovetail nicely into yours. This is sort of the firms, the compensation for the managing general partner with all firms with less than $1 billion. And this is on the map of the United States. And you can see that Northern California high, New York is high, and then the mid-Atlantic. So fill us in on how that's translating and what's going on with QSBS around the country.
Yeah, so getting back, the most important thing, getting back to what state you live in and whether or not that state recognizes QSBS. And there is two additions to this list that actually changed last week. I haven't been able to update the deck yet. So these are the states that will tax you on QSBS. California, of course, I think that's very well known. It's very unfortunate because that's where most of the QSBS companies are. But so you pay full capital gains tax in California, in New Jersey, Alabama, Mississippi, Pennsylvania, Washington. And then the two additional states now that are no longer recognizing QSBS are Oregon and Maine. So that's 8 states total are
It's
no
too
longer.
much money, right?
That what happened was the federal government changed the QSBS threshold from 10 to $15 million. They expanded QSBS, and then in response, a couple states changed the rules on QS because now they said, okay, now it's gone from 10
Right.
to 15 million. What are we going to do? Give them 100% tax free for everything? Like, and so they decided that they should just take away QSBS completely, and they will make billions of dollars more in tax money. So they got rid of QSBS. So now you have 42 states that recognize QSBS and 8 states that do not recognize QSBS. It's a huge difference here. And, I like to use this example because it's 2 states that both have very high taxes traditionally. You have New York and California.
Rounding error for them, right? And the investors you can see are continuing to go up. We did have a question that the state taxes for the individual, not the company that the investment is in, correct? I can be a New York resident, invest in a California company, and still
That's right.
qualify.
That's exactly right. It depends on where you pay your taxes.
And
Now, the caveat to that is if you were to gift your ownership into a Nevada trust and set it up properly, even if you live in New York, that trust will actually be taxed in Nevada, so it won't pay any state taxes.
And where's the most optimal place to set up that trust? Where are them? I mean, can you do this? Let's say now that Washington State and others don't have QSBS,
Yeah,
you set it up, then it's more advantageous, right?
that's right. The trust that you set up, if they're structured properly, will not pay taxes in the state that you live in. They will pay taxes in the state the trust exists in. Nevada's great because Nevada has no state income or capital gains taxes, no dividend taxes, and they recognize QSPS.
What about Florida? That must be another good one.
Florida is a great state. We don't create trust in Florida, but Florida is definitely a great state to have your residency.
Yeah. Okay. The last section I'm going to hit right now is carry dollars at work. And maybe you can tell us, Al, how this fits in. So, carry dollars at work is also what we track. And this tends to be used for some of the lower percentages of carried interest for more junior people because it's defined as the amount of carry you will receive if your fund achieves a 2x gross multiple. Maybe, Al, you want to talk about that. So, the number's obviously bigger. And that's the part that makes everybody happier. So you can see with these numbers, this is a managing general partner year over year by AUM 23, 24, and 25. And this is, these numbers are quite large. It's down a little bit for the 2025, and we're just now putting together 2026. But explain to us how this works with QSBS.
Yeah, I think it's really important. Like, these are your accelerators, right? This is what's going to get you paid more. And so I think from an early fund life in the early days of the fund, it's hard to manage, especially if you're one of the more junior investors on the team. It's hard to manage that you can make more than $10 million on one given investment. But to your point there, if that's how your firm is set up, the accelerators kick in. I've seen it happen time and time again where somebody did not expect to make more than $10 million on a single investment, now has 30, $40 million coming to them, and it's too late to set up the trust. And so that's why
Yeah,
it's
talk to
important.
us because here's like the carry dollar you're talking for. Like, here's an associate, for example, and you can see that these numbers are compelling, even a $500,000. So, what happens if somebody missed it? What's
If it's too late, if you
yeah.
have an investment that's exiting and now you try to, and it's going to make you $15 million and you want to come and create trust to help optimize taxes, the second that company is, it's a binding LOI, for example, it's like it's going to happen no matter what, then you cannot go and move that into trust and expect to have a separate tax exemption. The IRS is going to look at that like your money because you did it too, you did it
Earlier the
too
better.
close to the
All this
transaction.
planning,
That's it.
earlier the better.
That's right.
You set up trusts in Puerto Rico. We had a question come in.
We don't set up trust in Puerto Rico. No, we only do Nevada. Nevada is the best state in the country when it comes to trust. They allow trust to exist for 365 years. There's no state taxes. And Nevada has the best asset protection laws, maybe in the country, probably in the world as well. So Nevada law will protect your trust from lawsuits, creditors, bankruptcy, divorce, everything.
Yeah.
And so that's one of the biggest reasons why people use Nevada trusts.
Well, as we wind up here, Al, you've done a great job of already showing us some perspective, how things have changed recently in the last year, even since last week, as a matter of fact. What's on the horizon for QSBS? And we know you're super busy at GetDynasty. So what's your perspective on the market and what's going on?
I think that the states have gone back and forth on it. At the federal level, this has been bipartisan. QSBS was enacted in 1993 by President Clinton, and every single administration has either kept it or expanded it. It's never gone backwards. This really is, it's not just a rich person tax exemption. This is rocket fuel for the startup ecosystem. What it does is it incentivizes investors to invest in early stage startup companies. More investors means more companies, which means more employees get hired, and then more successful outcomes where
Yeah, more.
less taxes are paid. And then what the data shows is that that money that now you've saved in your taxes gets reinvested back into the startup ecosystem, either by investing in more companies or by starting companies at the founder level. And so it's rocket fuel for the startup ecosystem. And without it, you might have investors that decide it's too risky to invest in early stage startups, and they might go other directions, and we might have a lot less startups because of that.
Yeah, well, I couldn't agree more. I mean, and I think the piece of having QSBS and having your house in order, I mean, more and more we're seeing that firms are putting in formal compensation structure. Investing is a career track. It is no longer just for good old boy network. There are all kinds of individuals who are getting into the investment ecosystem, and they're starting out as associates, moving to senior associates. There's a career track. It's taking time, and there is time to plan, but getting your house in order is really important. So I have one last slide to show, which I think is important to see the median carry dollars at work across all active funds in the billion plus for some of the more junior positions as well, like director, principal, and senior associate and associate. And I think it's really important because, as you're saying, the wealth creation can extend all the way down the food chain. And so it's important to plan. It's important also to ask questions about what your compensation is, the carry dollars at work equation or the carried interest explanation, so that you understand not only what you own, but how you own it. And then you make sure that you plan for the wealth creation, because you're not in it thinking that you're not going to have that. And also, we would love for you to participate in the survey, because you can see we have a lot of great data that we want you to have and be armed with at your firm. So if you participate, you get access to what you give for no charge. We did have one last question, since we're at 129. At what carry dollars at work do GPs typically start gifting vertical slices to trust?
That's a good question. I think I don't have the answer to that. What we see is it's all about your confidence and your ability to make more than $10 million on individual
Yeah.
investments. If you have that potential, then start creating trust. If you don't think you have that potential, then there's not as much urgency.
We had one last question. If you're not setting up a trust, do you need to be, okay, hang on. Do you need to be filing anything to be eligible for QSBS, like with an 83B election?
No, you just want to make sure that you know which investments are QSBS eligible and which ones aren't. Because when you do your taxes, you'll have to tell your CPA which ones are QSBS and which ones
Yeah.
aren't.
And when you join a firm and you're issued carried interest, but you were not at the firm when the QSBS investment was made, you can still go ahead and do this, right?
Yeah, if you have carried interest in the fund that has a QSBS investment, absolutely.
Anytime.
Yep.
Great. Well, we've got everyone gained a momentum towards the end with the questions. We appreciate you taking the time today. We'll send out a follow-up from here. And then certainly if you have questions, you can reach out to Al directly or to us here at Thelander. Perfect. Thank you.
Thank you.
Thanks, Al.